today's webinar, Global Investment Outlook, The Way Ahead. I'm Nidhi Shah, Vice President, Market Insights, Wealth and Personal Banking at HSBC India. Before we understand the way ahead, let's understand where we're standing currently. With a highly anticipated US election behind us, it's time to assess the evolving geopolitical and global landscape. The chatter on the possibility of the US recession has reduced and shifted to potential trade tariffs, tax cuts, and policy actions with the new US administration intends to initiate. On the domestic side, the earnings release, coupled with regional reallocation by investors, led to re rating of stock prices across sectors. To put things in perspective and read through the incoming data, we would like to invite our expert speakers for today. Our first speaker is Mr. James Cheo, Chief Investment Officer, Southeast Asia and India at HSBC Global Private Banking and Wealth. He provides thought leadership on investment strategy for wealth and personal banking clients and has almost 2 decades of experience in investment and has worked extensively with marquee organizations across the regions. Second expert speaker is Mr. Abhilash Narayan. He's the investment strategist at HSBC Global Private Banking and Wealth. He's a member of the bank's Global Investment Committee besides JAM and is responsible for driving investment views for ASEAN and Indian region. He has more than a decade of experience providing thought leadership across asset investment strategy for private banking and wealth management clients. We shall start with James sharing outlook about the global investment scenario, dovetailing finally into the India investment scenario by Abhilash, and moving on to question and answer. I'll hand it over to James now.
Well, thank you, Nidhi, for the wonderful introduction, and good afternoon, everyone, to this call. Well, I think it's an opportune time to look into 2025 and to really think about how the world will shape up post the US elections, and also in terms of your investment portfolios, how should you think about constructing it? And you know, it's quite interesting. I start off asking kind of AI what 2024 looks like. And essentially, I keyed in these words, hard landing, soft landing, electoral cycles, kind of Trump 2.0, Fed rate cut. And this is what I got for 2024. Hopefully 2025, I mean, the picture looks quite interesting. We've got two Trumps, one, I think it looks like two China president, but that China president looks a little bit like Elon Musk. But anyway, that's what AI's hallucination is really about. So I think to dive into what does a Trump presidency or Trump 2.0 means. But I think to have a perspective, we should look at the US economy first before kind of putting any inference on what policy would be. But I think by and large, I think the US economy has been extremely resilient over the last 2 to 3 years. And essentially, the labor market, if you think about it, for the past 2 to 3 years, the resilience actually comes from immigration. And you can see that there were, especially back in 2022, 2021, there were more than, at times, almost a million jobs added per month in the US. And it's really a kind of a transformation in the United States, in which there were jobs that regular Americans don't want to do, and the immigrants went there to take up those jobs. So I think that's, it's just like in a football match, you have 11 players. And in the case of the United States, you keep getting an additional player playing for them. And that's why America, over the last 1 to 2 years, have been growing at almost 3% economic growth. And if you add inflation right now, it's probably nominally growing at around almost 5%. So this is a very strong growth outlook. But of course, the addition in labor market has been slowing down, really because of higher interest rates that's actually biting into the economy. And I think going forward, there will be pressures on immigration, which later I'll talk about, and the implications of it. But if you look at unemployment rate, I think it's still fairly low by historical standards. Yes, in the month of October, we did see a spike up, but since then, it has stabilized at around 4.1% in terms of unemployment rate. So, in most economies, the economy can keep growing and growing and not enter into recession, especially if you take reference from Australia, for example. Australia never had a recession for almost 20 years, really because of immigration that went into the economy. And that could be likely the case if immigration flow is allowed in the US economy. But we know that this picture might not continue on in the months ahead. So this is something to kind of watch out for and think about it. But because of this whole immigration that went into the United States, and of course, if you couple that with the productivity gains from particularly developments in the Silicon Valley, where you have had the AI revolution that is actually increasing productivity of companies, of workers. We do see a kind of a Benjamin Button effect. For those who watch the movie, that guy just becomes younger and younger over time. So because of all these factors, that late cycle that we started 2024 for the US sort of got pushed back, and the economy sort of became younger in that sense from a late, perhaps now we are perhaps in a mid-cycle because of the increased number of people in the economy. That actually gives strength to the economy, and also the productivity from technology, from AI, that actually extends the economic cycle. So we are in a fairly good shape when it comes to the US economy, even before the election of President Donald Trump. And one of the reasons why US is so resilient is really because of fiscal spending. Fiscal spending is around 6%, 6.5% of GDP. So it's extremely hard for the US economy to enter into a recession, really. And this has been the amount of spending over the last 1 to 2 years. So if you can think about it, the fiscal accelerator is being pressed to the extreme in more ways than one. And at the same time, on the monetary side, yes, it was very tight, 5.5%. In terms of interest rates in the US, but that is also starting to ease. We have seen the first rate cut in September this year, and perhaps we're going to witness further rate cuts going into 2025. So you have both accelerators, fiscal policy as well as monetary policy, going to be extremely easy, which would support this entire growth dynamics in the United States, which will actually in some ways reinvigorate capital spending for many companies in the US. So I would say that what would a Trump presidency mean? I think there are various components of his policies that could be a good Trump. We've seen it before. So things like tax cuts, the extending of tax that were expiring, that could be very likely be extended for the next 4 years. You might see perhaps increased fiscal spending, but that got to be pushed through the two houses. Yes, Trump has a kind of a sweep in terms of the Republicans for both houses, but some of the bigger fiscal spending programs still got to be passed through members of Congress, which is still not, it's not something that is being. It might not be as easy as one thinks. But clearly, I think monetary fiscal policy is still going to be fairly easy. And also there are aspects such as deregulation. I think that is something that could be, that's positive for industries, for companies. So there might be less regulation, especially for financial companies, that could perhaps even encourage more merger and acquisition to occur. So there are components of Trump policy which can be, good for the economy. But of course, there are components that could be bad for the economy, such as tariffs, for example. I think that is one aspect that could perhaps escalate, create tensions geopolitically as well. And also, of course, tariffs will slow the economy down. And in some ways, tariffs does induce or introduce inflation back into the economic system. So this is something that it's worth watching, and also it's worth thinking about when it comes to your investment strategy. And also there is another component, which is immigration. So that's something that I talked about earlier on. So how much immigration the new administration is going to curtail, how much control that's going to come about, it's still very much unknown. And I think as a result, how we should position ourselves also depends on how all these policies are being sequenced over the course of the next 4 years. Whether the good part is being front loaded or the bad part is being front loaded and how it's being sequenced, I think it all matters. So these are things that we are watching out very closely. But suffice to say, from now to inauguration, which is 20th January, based on the economic situation, which is still extremely solid, I think the case for equities to outperform, particularly US equities and US assets, I think still holds quite true. So I think from that perspective, the whole election outcome points to US exceptionalism, particularly for US assets. S&P 500, I think, or US equities, I think, continues to be a place where capital will be kind of attracted to, or capital that's been invested in the US, I think, would continue to be there. A lot of the capital was initially in the tech companies, and I think that could be broadening out to other sectors as well in the weeks and also months ahead. So, of course, the Fed's rate cut is positive for markets. If you look through the whole perspective, the Fed is cutting from a position of strength. When the Fed cuts interest rates, typically it's because of the economy going into trouble. But this time round, the economy is extremely resilient. Inflation is starting to go nearer to their 2% target. Not there yet, but I think from an interest rate perspective, I think it's worthwhile that the Fed will continue to cut interest rates in 2025. December, I think there is a chance the Fed will continue to cut 25 basis points, and perhaps we might see another 25 basis points cut in 2025. And if you look through history, and I think one of the most relevant part is actually in the 80s, when the Fed cut interest rates. Initially, there was an attempt to cut interest rates to kind of tame inflation. That happened during the 1980s, where the markets in the US actually pulled back almost 30%. But look at when the Fed starts to cut interest rates across 83 to even 87. That created an extremely big rally in the US market. So I don't think that we might see a 224% increase in the US stock market. But I think we might be in this sort of period where interest rate cuts provide a support for the US markets. And clearly now, if you add Trump's policy, which is primarily to protect and to enhance US corporations, that gives another boost to US equities. So if you look through history, just like what my earlier experience, the chart shows in the 80s, if you don't get any recession in the US, which is unlikely for 2025, and you get an interest rate cut, typically it's a very bullish or very positive time for global equities, especially the US. And these are all the experiences. No recession, interest rate cuts. US equities tend to do extremely well. And I think 2025 is shaping up to be that sort of year. We might not get that bull market because we have had a bull market already this year. So I would say the bull perhaps in 2025 might be an aging bull, if you will. We might not get 20%. We might get maybe a low teens kind of return, similar to a sort of the earnings growth that we might see. We might see a lot of the increase in returns in the first half, perhaps, given that a lot of the policies are still very conducive. And then maybe there might be volatility because we know that markets don't move in a straight line. So there will be, for sure, 2025 bouts of volatility as triggers because of geopolitics or anything that could cause sell-offs. But by and large, I would say that generally, I think next year should still be a good year for equity markets. In terms of bond markets, it's a bit trickier this time round. I think US 10-year bond yields have, because of kind of inflation possibilities and perhaps even some worry about a fiscal deficit, US 10-year has reached around 4.5%. I think at this point, there might be volatility there. It's very hard to call whether would it go further up higher. But I think we are at a point where in terms of rates, rates are only, I mean, credit is extremely tight. Equities, yes, it can go higher, but valuations are not cheap. Rates are cheap, but I would say there is still going to be ongoing volatility given that a lot of Trump's policy is still unknown, and a lot of them are inflationary in nature, whether it's immigration control, tariffs, fiscal spending, all these are inflationary in nature. So I think markets are grappling it. It's hard to kind of price that in. And also the sequence and implementation matters because ultimately how the Fed would react depends on how inflation will come into the system. So that will take time because let's say, for example, if Trump managed to pass through his fiscal plans, maybe second half of 2025, the inflationary effects will only come in 2026. So it's hard to kind of put the inflation premium into the bond markets now, and that's why I think there's quite a bit of volatility, especially for long duration rates. And that's why I think from our perspective, we want to be neutral on investment grade long duration right now. We want to be a bit neutral there, where we see the opportunities are perhaps in the belly of the yield curve. Perhaps 5 years, I think it's quite a good way to kind of lock in that yields. If you have cash, why not lock in at 5 years for some of the good quality corporates where you could, kind of get that in terms of coupons. And if we do get a kind of bond yields falling as a result of a stabilization in the inflation view sometime down the road, you might get, and you will get a capital appreciation from there. So I think there is a case to put your cash to work in bonds, but again, you've got to be a bit more flexible. Don't need to chase long duration. I think it's worthwhile looking at the belly of the curve. Stock markets, I think stock markets have had a good run. I think that run can continue on, but perhaps, as I've mentioned earlier, that bull will probably be an aging bull. This year, it's been driven very much by the Max 7. I think next year there will be a broadening out in terms of the winners, because I think capital will still be very much attracted to the US because of the US exceptionalism in terms of growth. Other sectors can do well. I think things like financials, for example, I think that's a sector that can do well amidst yield curve steepening. And of course, if you do get deregulations with M&A deals coming in, I think US financials can actually do well. Healthcare stocks, particularly those dealing with the obesity drugs, they have come off a bit recently, but I think the long-term demand for such GLP-1, the anti-obesity drugs, I think those companies, I think, can still be quite a good team to think about when it comes to the next generation medicine. So healthcare is another sector that looks quite interesting. So I think there is a case that you should still be invested in equity markets, particularly in the US. Heck, yes, you've got to hold it, but I think increasingly there is a case to broaden into the other sectors as well, such as financials, such as healthcare, and perhaps even industrial is one whereby if you do get more policies by Trump to kind of reinvigorate the reindustrialization of the United States, I think industrial looks quite an interesting sector to think about. And now, how about Asia? I think Asia, it's something to, the picture will be a bit more nuanced. It's not so clear-cut. Unlike US, I think it's quite clear, where generally US assets, particularly US equities, even US dollar could do well. Asia, I think, would be a bit more nuanced because in this environment where the dollar is stronger, there is a headwind for Asian equities, even though I would say a lot of the Asian markets still have very strong earnings outlook in 2025. Of course, the elephant in the room in Asia would be China. China is actually going through a period of disinflation. If you look at the kind of the CPI or the inflation in China, it's roughly about 0.5%. But if you strip out food prices out of the price index, China is actually in disinflation. So when there's disinflation, consumers will hold back their spending. They'll wait for the next month to spend just in anticipation that prices will fall. So I think it's a situation that it's quite precarious, and the government knows that, and they need to break this whole disinflationary mindset, if you will. So they've come up with this whole kind of three arrows of taking the playbook from Shinzo Abe back in 2014, almost 10 years ago. And this three policy ammunition is really to kind of break that whole cycle of disinflation. So they went fairly big on monetary policy. So they've cut interest rates, put credit in the hands of banks to lend out. That they have done quite significantly over the last month or two. And now, of course, is fiscal policy. They have been at the sidelines trying to increase more fiscal spending. But the fact of the matter is that China's fiscal debt, compared to back in 2009, has increased significantly since the financial crisis. And so, as a result, they are a bit judicious on how much they would increase fiscal spending, because the model of China's economic development post-financial crisis was really through housing, infrastructure spending, and a lot of that is borrowed. So I think they are a bit reluctant to increase the level of borrowing. So right now, what we've seen in China's case is that they have introduced debt swaps on the local government financing vehicles. So essentially, they have announced around 1.4 trillion US dollars of such debt swaps. Essentially, they are pushing back or extending the duration of a lot of this debt that were actually maturing. So I would say that it's, at this point, they are not going very big on trying to increase the 80% fiscal debt level. They are kind of holding it there first to perhaps on a wait and see mode, because they are not sure at this point of time how the Chinese economy is weak, and of course, if you do get tariffs from the United States, if there is a 60% tariffs on Chinese goods, that is quite detrimental for the Chinese economy. And in order to kind of equalize that, the Chinese would have to depreciate their currency by 60%, which is not possible. It's too big a move. So they have to be quite judicious to try to use fiscal policy to, at the margin, offset those tariffs effects. You can't 100% offset one for one. But I think they want to be quite careful in how they navigate through this more tricky period of time. But ultimately, of course, the main strategy for them is structural reforms. Essentially, they want to move away from a very much a property-led model, which has been over the last 15 years. They've overbuilt houses. They've built 120 million houses that can house 120 million people. So that's a lot. And if you give them a choice, they will want to export it to everywhere in the world, including India. But they can't. The houses are fixed and it's all built there. So they can't export the houses. So it takes time for those houses to be absorbed into the economy. So this is an issue that China faces. So I think that if they were to spend, they are trying to spend on high quality growth sectors, the likes of new technologies, the likes of semiconductors, the likes of renewable energy, technology associated with that, electric vehicles. I think that's where the spending will be. And it takes time. It doesn't... by spending into these sectors, it doesn't reap immediate returns instantly. So I think it's a process. As a result, if you look at the Chinese stock market this year, after the first arrow is being announced, the monetary policy that was announced, China experienced a bull market. A bull market in 1 week. The US took a year for that to happen, almost a year. China, 1 week, we got a bull market. So that's the situation. But since then, because of the lackluster expectations of fiscal spending, we have seen some of these pullback that has occurred since then. And clearly, I think that the next arrow of fiscal spending is something that everyone is watching out for, in addition to perhaps even the tariff risk that could possibly come. So there are a few dynamics that's actually playing out right now in China. And so these are things that one is watching out for. But I think by and large, if you look at next year, Asia still stands out as a very strong growth engine. Clearly, I think China is slowing down. I think if it needs bigger fiscal spending for it to reach its 5% official target, and that's what they want to achieve. But by and large, of course, I think India is still going to be extremely resilient. From a global context, it's slowing down slightly recently, but I think as a whole, it's still one of the sources of very strong economic growth. And I think Abhilash will talk more about where the growth is. And I think the big driver would, of course, be demographics. And I think he will cover that again. So I think one of the very interesting aspects that this region is that investors cannot just look at China alone for this year or even next year. You have to look at India as well. You have to look at ASEAN as well. And I think the fact of the matter is that if you look at India's case, India's the service exports is around $350 billion for 2023, which is a huge amount. That's the combined earnings of the Magnificent Seven. So nobody really talks, Mac 7, the whole world is talking about it. But India's, service exports from the GCCs, same amount of earnings, but less attention. So these are, the quiet or the silent earners that I think the world should put more attention on. And I think this is something that I think we can be a bit more bullish on, really, because not everyone's attention is on it, but it's really something that generates a very, very strong revenue. And of course, in ASEAN's case, ASEAN is also another silent economic juggernaut that is growing every year, 5 to 5 and 6%, one of the largest rising middle class. But yet investors have really ignored ASEAN as a whole. And ASEAN, I think, presents quite a lot of very interesting kind of income plays for investors to think about income. Well, Singapore is a solid market for income. Indonesia, even Philippines, both of these countries, on a local rate perspective, are offering above 6%. So quite interesting places to look for income. So I think to summarize, I would say that for 2025, again, I think you've got to be exposed to equity markets. And I think US exceptionalism can still continue on, but perhaps instead of just looking at tech sector, you want to be exposed to other sectors as well, because I think there will be a broadening out that will happen. Cash, again, I think you want to put your cash to work. I think bonds, you can lock in some yields there, but I think you don't want to chase after long duration. I think middle of the valley, I think, works very well. In terms of Asia, we are neutral on China right now after that run-up we've seen. We prefer India right now. We are overweight in India, and I think Abhilash will talk more. And I think in ASEAN, we take a more nuanced approach. We like Singapore in terms of equity market because of the income that you can get from many of the dividend names. And Singapore actually is one of the best performing markets in the region, up 30% this year if you look at MSCI Singapore, which is also another very strong growth story, but very much ignored or not really covered by most media in terms of the increase. So I think with that, I would, I started the presentation with an AI. So I've asked AI what 2025 will be, and this is the picture that I got. Trump seeming to say, it feels like he's trying to say that the may the force be with us for 2025, and the background looks a bit more optimistic. So I hope that 2025 will be better for investors. And with that, I'll hand the time to Abhilash to go through his view and our view on India and where the opportunities are.
Thanks a lot, James. And that's a great segue into India. Now, before I talk about our views into India, right, I wanted to just share that, at HSBC, we are fairly constructive about the outlook for Indian economy for the next 5 to 7 years. And, when we say that, we obviously realize that India is obviously a country which has a lot of contrast. It has some challenges and it has some really strong strengths. I mean, when I was thinking of India, right, we've got, India being a powerhouse in the software sector, as we all know, but at the same time, India lagging, other Asian countries when it comes to literacy. India, if you're a cricket follower like me, is the country which can get whitewashed by New Zealand in home test series, but can, go toe to toe against Australia in Perth, as it happened today. And it reminded me of, the famous movie from 2023, which was RRR. And there you had two characters, Raju and Bheem, who were very opposite, but they combined together to deliver good results. And we think that for next year, India could follow a similar theme. So we have an RRR theme for India, which is Renaissance, reforms, and returns. So let me take a few minutes to talk what these mean. and then we'll talk about individual asset classes. So uh, when we talk about India, obviously James did allude to it. India is in a place where it does benefit from very, very favorable demographics. So if you look at the projections from United Nations, India's population, especially working age population, is expected to continue to grow till at least 2050. Whereas if you look at ASEAN, it'll grow modestly and then stagnate, and in China, it's going to come down. And one very, very key advantage for India is that the population is young. The median age of population is around 28, 29 years, which presents India with a huge demographic advantage when it comes to, growth is concerned. Secondly, if you think about urbanization, right now about 35% of India's population, if you go back to previous slide, 35% of India's population lives in urban areas. By 2047, that's projected to increase to almost 65, 66%. And that again would be, a key long-term driver of growth for India. If we go to the next slide, which is reforms, obviously, when you think about reforms and we take a step back, uh, over the last 10, 12 years, there has been a massive amount of reform that has happened in India. So the first one is digitalization. We all know that Aadhaar initiative started, decades ago. Then, in the past 8, 10 years, there's been a huge focus on digitalization. I was in India in Ahmedabad in December last year for my, alumni meet. And one thing that really surprised me was that no one was accepting cash or even credit cards. When I went to restaurants or any other place, everyone was like, भैया यूपीआई कर दो या स्कैन करके पे कर दो. And that just blew me away that the digital transformation in India, especially in payments, has progressed at a much, much faster pace than most of the other, even developed nations. Uh, if you look at the chart on the left, that just shows you the increase in UPI transactions in the past, 5, 6 years, and they are projected to increase for the next 5, 6 years at a very healthy pace. In fact, last year almost 76% of India's GDP equivalent transactions were done digitally. So India has made a massive amount of progress as far as digitalization is concerned, and we expect that to continue and be, a source of growth for India. Infrastructure, we all know, we live and see it if you're in India. The massive amount of improvement in highways, in number of airports that are there. So that's a big positive as well. And lastly, Prime Minister Modi, when he came to power in 2014, he did, start the Make in India scheme with a lot of gung ho. Obviously, that scheme took a little while to get up to speed, but as James pointed out, India's exports have been increasing at a rapid pace. Services exports are at around 350 billion. Manufacturing exports are at 440 billion. And the government has laid out, the Viksit Bharat vision over the past few months and quarters. And the plan is to increase India's exports to 2 trillion by 2030. Now, that has been aided by, tax cuts or tax breaks for certain industries. And we are starting to see, progress around that. I mean, I was surprised when I read a statistic that India is now the second largest manufacturer of mobile phones in the world, right? That took me by surprise. And if I look at projections by various consulting houses, they project that India's electronics exports are, poised to grow eightfold by 2030. So we think that export growth in the next, 5 to 7 years would again be a strong driver of growth for India. Moving on, obviously all of these factors support very, very healthy medium-term growth projections that we have for India. So if you go to the next slide, we think that this growth will actually translate into solid returns for both equity and bond markets. So the slide on the left shows you the returns for MSCI India versus MSCI Asia Japan. India has outperformed, Asian equities for in 2021, 2022, 2023. This year, it's after the recent pullback, it's come broadly in line with Asian equities, but it's still delivered, healthy returns. And Indian bonds, they've outperformed global bonds and emerging market local currency bonds. And we think that with the RBI rate cut cycle expected to start, early next year, that outperformance could actually continue. So we continue to be bullish on Indian equities and Indian bonds, and I'll go into more detail about that in my later slides. Now, if we talk about the economic outlook in the next slide, uh, you know, uh, obviously, Indian economy has been growing at a very, very fast clip. We saw certain quarters where GDP growth was over 8%. In the recent quarters, the growth has slowed down a bit. If you look at some of the high frequency indicators, such as industrial production that has, signaled some red flags. But we think that the picture is mixed. So if you look at manufacturing PMIs, they still continue to be fairly healthy, around 57. Just for reference, anything above 50 indicates that the sector is in an expansionary territory. So manufacturing and services PMI remain well above long-term averages. But we do need to recognize that there are pockets of weakness. So if you look at the recent earnings season, there were some comments by companies that urban demand was slowing down. We've seen automobile sales slow down from the levels we were accustomed to over the past few quarters. And that's reflected in the fact that credit demand has slowed down a bit, and it's now become to more in line with what we've seen historically. But if you take a step back, right, what this means for us is that yes, the growth is slowing down from an elevated pace, but we still expect the growth to be healthy at around 6.7% for 2025 and 6.5% for 2026. So that's still better than the growth projections we have for any of the other G7 economies out there. Now, what does it mean for financial markets, right? Because that's what we are more interested in. So if we go to the next slide, we obviously have to talk about the pullback we have seen in Indian equities in the last, month or 2 months. Now, if you remember what James was mentioning, right? So China did announce a massive stimulus, a fiscal stimulus, in late September, and that saw Chinese equities run up by more than 20% in a matter of weeks. Now, what happens in such instances is that international investors need to find money to allocate to Chinese equities because they want to chase that rally. And Indian equities had done extremely well for the past 3 years. So what we've seen is that there was a massive amount of outflow from Indian equities by foreign investors in the month of October, as well as the first few weeks of November. And the black line just shows that outflows, the year-to-date inflows and outflows in Indian equities, and the peak in Indian equities coincided with the peak in the flows, and then outflows have coincided with the pullback. Now, just to put it in context, if you look at the chart on the right, that just shows you the monthly inflows and outflows into Indian equities. And in October, we saw the highest amount of outflows from Indian equities ever recorded, right? Now, if you're a glass half full guy like me, I would see the market performance as actually, something which is a positive. Despite the record amount of outflows, Indian equities actually were relatively well behaved. They were down 7-8% in October, but things could have been a lot more worse. And one of the reasons why Indian equities did not fall more is there still continues to be a very, very strong domestic investor base support. So if I just look at the SIP amounts that go into equity markets every month, that's around $3 billion equivalent, right? So if you analyze it, that comes to around $36-37 billion of SIP flows going into equity markets, predictable flows. And that's not accounting for the lump sum flows that happen here or there. So we think that the strong domestic investor base is a very, very powerful support for Indian equities. Now, if you look at fundamentals on the next slide, we are still very, very, comfortable with the fundamentals. Yes, when you talk about Indian equities, people talk about the fact that PE ratios are elevated, around 24, 25 times. But if you try to take an analogy with tech sector, right? If you look at the big seven, the Mag 7 companies, they also trade at very, very high valuations. But the reason why they continue to perform is that they deliver strong earnings growth. They deliver strong return to equity investors. So looking at just PE ratio alone does not give you a complete picture. You have to look at the return on equity that investors get. And then if you compare India versus some of the other major markets, US, Asia, Japan, China, etc., then Indian equities do seem to be reasonably priced when you look at the return that they generate. Looking ahead for 2025, consensus still expects 16% earnings growth for MSCI India, which is the internationally tradable index. And admittedly, we could see a bit of downside to these earnings estimates, but even if it comes down a bit, we'd still see double-digit earnings growth for next year, which is much, much better than a lot of other equity markets out there in the world. Now, when you combine that with the fact that India is relatively insulated from a risk of trade war that James just mentioned, we think that all of these factors combine to paint a fairly favorable picture for Indian equities, and that's why we continue to be overweight on Indian equities for 2025. Moving on to currencies on the next slide. Obviously, with the fact that when Donald Trump was sort of clear that that he would be the president, that sparked a rally in the US dollar, and as a result, we've seen dollar INR hit record highs, or rupee weakening to record lows. But it's important to look at these movements in context, right? I was just looking at the euro earlier today, and that's fallen almost 6.5% since Donald Trump became the president, or it became clear that he won the election. So when you compare 6.5% fall in euro, and you look at how much the rupee has moved, you'd realize that rupee has been very, very stable. The chart on the right actually shows you that the volatility for rupee is lowest amongst the major sort of BRICS nations which are out there. And a key reason for that is RBI has been using the war chest of FX reserves to manage the volatility in dollar INR. So we think that with Trump coming in as president, the policies that James alluded to, dollar would strengthen. So we expect dollar INR to sort of weaken modestly by around 2% in 2025, but that should still be much, much better than other emerging markets. So we expect a gradual sort of grind higher in dollar INR. Lastly, on the bond markets, Indian bonds from an international perspective still continue to be very, very attractive. If you look at the yield offered by the various countries which are rated investment grade by international agencies, India, as you see on the chart on the left, offers the highest yield, closely followed by Indonesia. So the amount of coupon that you get from Indian bonds is very, very attractive. As far as monetary policy is concerned, we do expect the RBI to start cutting rates from February. Obviously, the recent uptick in inflation means that RBI is unlikely to cut rates in December, though it's likely to be a close call. But we think that they'll start cutting rates from February 2025. So once they start cutting rates, we do expect bond yields to come down a bit, and that should lead to capital appreciation for bonds in addition to the coupon that you get. And if you're looking at the supply demand dynamics, we think that they're very, very favorable for Indian bonds. So some of you may know that Indian bonds were recently included in three major international bond indices, indices run by JP Morgan, Bloomberg, as well as FTSE. And what that means is that Indian bonds are likely to see anywhere between $40 to $45 billion worth of inflows over the next 12 to 18 months. And that should mean that the demand for Indian bonds should be much, much higher than the supply, especially given the fact that the government is trying to reduce the fiscal deficit. So that favorable demand supply dynamics also leads us to believe that that yields should edge lower from here on. So net we remain bullish on Indian bonds as well. So yeah, with that, let me stop and hand it over back to Nidhi.
Thank you so much, James and Abhilash. It was quite interesting to learn about insights, global Indian, and how we kind of spoke about RRR while we also talking about insights, how China would as well like to export houses as well if they could. All also learned about the silent earners, which it was quite insightful. So post the session, we have already received quite a few questions from the audience. So James, there are some of them specifically towards the global markets, which you kind of alluded to in the beginning. And whenever we talk about the geopolitical landscape or a major event, the conversation does definitely shift to commodities, specifically oil or gold for that matter. So definitely the markets have lived with geopolitical tension, but recently we had the US election and the policy implications. So how do you read a possible impact maybe on commodities like oil and gold in light of the recent events?
Yeah, let me try to break down one by one. I'll cover oil first. And if you look back historically, when Trump first won the presidency back in 2016, you would imagine, and you compare that with Biden winning, the election back in 2020. You would imagine that or oil stocks would do very well under the Trump administration first time round. And then under the Biden administration, you would expect oil stocks to do badly under Biden's administration because Trump favors fossil fuel companies. But the truth is the other way around. Under the Biden administration, energy companies actually outperform significantly. And the reason is this, because the picture is actually very complex. Because back then, 2020, oil price actually turned negative and it bounced back significantly much higher from the negative levels to something positive. So oil price did very well from coincidentally, and at that time when Biden became president. And also because oil price is determined by a lot of other factors. It will be it depends a lot on global demand, how strong the economy is at that time. It depends on the supply outlook for oil. A lot got to do with what's happening with OPEC, what's happening in US shale production, and also I think what's happening perhaps even with geopolitical risks. Will oil supply get disrupted? So I would say looking into 2025, it's hard to kind of say that geopolitical risk would be eradicated. I think geopolitical risk would still very much be around, if not elevated. So I would say, at least on the global demand side of things, you might see a little bit of slowdown in global demand, just given that global growth might slow down a little bit. Yes, there's resilience in the US, but I think globally things are slowing down slightly. So I would say oil price might just be a bit range bound from that perspective. On that, global demand will be the main factor. But I'll be, of course, very watchful of supply side perhaps disruption, if any, not because that those geopolitical factors could just erupt, which something that we can't predict. So that's on the supply side. But if you do get policies from Trump that favors some of these shale companies to increase production, in fact, that would increase supply and that would bring down prices too. So I would say sideways. I'm not bullish on oil in any way at this point, given that it's hard for me to kind of predict if there will be increased supply side disruption. But I think generally sideways movement for oil. In terms of gold, I think it's related to geopolitical situation. I don't think we will eradicate geopolitical risks. So there is still a place for gold for portfolio diversification. And of course, if you do get a reduction in interest rates, typically gold price should be well supported if we continue to see the Federal Reserve cutting interest rates. So I think as a whole, I think if you look at it, I think there is a case for gold as a portfolio diversifier in 2025. Thanks for the question.
Thank you, James. So basically, Trump leaves some surprise whichever way we go. I mean, oil, there is something he could do, he could not do, so we really don't know. So there's an unknown factor which always brings in. Thank you for that, James. Abhilash, I'll take the next question regarding India. So there has been a lot of talks, in the Q2 earnings, which have slowed down, and FMCG companies, consumption companies, or even automotive companies have been talking or alluding very clearly to urban consumption slowdown. How do you kind of read, within this loud noise about urban consumption or rural consumption for that matter?
Thanks, Nidhi, for the question. And clearly, this is something that we've been monitoring as well. And I think I did allude to it in one of the slides. So yes, in the latest earnings season, I think earnings did disappoint the consensus expectation, and to a large degree that did happen because well, energy sector had some challenges in earnings, but the consumption side there were some unexpected downside surprises. Now, if I think about the urban consumption, yes, it has slowed down, but it's slowing down from reasonably elevated levels. And if you think about some of the capital goods like automotives, etc., we have to be cognizant of the fact that there was some front loading of demand in the past couple of years. There was a replacement cycle that happened post the pandemic reopening. So the slowdown that we have seen is not completely a surprise. But I think you have to think about it from both perspectives. Yes, urban consumption is slowing down, but if you look at rural consumption, we are starting to see green shoots there, and that's due to three factors. Firstly, if you look at the budget that was announced earlier in the year, there was a clear shift in the government focus from just focusing on infrastructure in the past few years to actually focusing more on schemes to support rural incomes, rural consumption, and we are starting to see signs of that coming through. Secondly, we obviously had a good monsoon season. If you look at the crop sowing, that's increased year on year. The distribution of rains was also quite favorable. So we do expect, the good monsoon and the related harvest to lead to higher rural incomes, and that should feed through to higher rural, consumption. And lastly, because rural consumption was so subdued for the past couple of years, we are starting off low base. So the delta that you'd see would actually be more significant. So we think that these two impacts should largely offset each other. But yeah, when clients are looking at investing in consumption related sectors, etc., I think it's important to be selective. But from our perspective, we think that financials and industrials are two sectors where the outlook is a bit more clear. So we are more positive on both of these sectors.
Thank you so much for that, Abhilash. It does definitely make sense to what we are reading and what we are kind of getting to hear very often, because to a great extent, everybody seemed gung ho when the earnings results started coming in and some of the prominent FMCG companies started talking about the slowdown. It seemed that, things were completely reversing, but it's good to get understanding and perspective from the data. So thank you so much for that. James, I'll take the next question in terms of US again. So definitely, whenever anybody talks about Trump administration or the possible, policy implication, tariff is something that, appears very prominently, and the kind of tariff hikes probably that US is specifically, planning for China or intended for that matter, gives a picture that, we might also see inflation, jumping in again. So even though Fed has started your rate cut cycle, do we actually see, inflation rearing its ugly head again? How do you read this entire situation, tariffs and the possible inflation impact?
Yeah, I think one shouldn't overreact and over assume everything is all in. So yes, Trump gave big numbers on tariffs on China, 60% tariffs, but by and large, if you think about it, almost most of the goods from China that's selling into the United States are already at tariffs levels around 20 to 30%. So it's not from 0 to 60, it's already at a certain level. So that's number one. Number two is also, if you look back when when Trump introduced those tariffs, the impact on inflation back in 2016 and 17 has been quite subdued. Yes, I understand that it's a different time back then, but the direct impact was quite subdued back then. And also, if you think about the possibility of negotiations between China and the United States, there could be a period where, and looking at how Trump dealing with business, it's likely he introduced a big one-off increase, and then there might be negotiations along various various other goods to kind of bring down that level, and there are other negotiation chips that could be available. So I suspect it could be a prolonged process. So I mean, as investors, you don't want to make a sudden knee-jerk reaction. We should adjust allocation if that happens or when that happens. But again, I think one shouldn't kind of jump to conclusion so fast. And also, I think it takes time for inflation to trickle back into the system. And with tariffs, it has an inflationary impact, but it also has a disinflationary impact, because let's say if prices increase too much, consumers could hold back spending. They could substitute buying certain goods. They can reallocate their spending. And that's why I think in some ways, because of the reallocation of spending, we didn't see inflation picking up that significantly back in 2017 when the first round of tariffs were introduced. So I would say that it takes it depends on the whole entire sequence of policies. I think that's one that you have to watch out for. And also there is a disinflation. As much as there's an inflationary impact, there's also countermeasures by various parties, and also there's a disinflationary impact of tariffs. So having said that, I think we have to watch the developments very closely, but because it's so complicated, one shouldn't totally priced in and avoid, let's say, for example, avoid all sorts of or make knee-jerk reactions right now. And I think one should kind of use certain broad strokes to guide our thinking when it comes to especially Asia investing. So I think the few broad strokes I would say would be look for countries with big domestic exposure, look for domestic winners, for example. I think that's one very sensible way to think about it. I think India has lots of domestic winners that could be shielded from all these tariff risks. So that's one source of opportunities to kind of get shield from these tariff tensions. ASEAN, for some countries in ASEAN, could be a bit more resilient as well. Likes of Indonesia, certain sectors in Indonesia, the domestic side of things could be quite resilient. Some parts of the property or REIT sector in Singapore, I think that could also be a bit more resilient when it comes to all these tariffs. So yeah, I think there are a few ways to have a few broad strokes to kind of guide you through. But I don't suggest one should jump to conclusion that tariffs, that we're getting all the tariffs right now, day one, and then, it will just lead to inflation and then you just exit a lot of those inflation-linked sort of ideas.
Thank you so much for that, James. I guess it kind of turns the entire question on its head. I mean, it could lead to disinflation as well. So thanks for bringing that very different perspective, because that's how people have been equating in a very simple fashion that tariffs will directly lead to inflation. So thank you so much for that. We're very close to the closure, but I'll take one last question, from Abhilash. It's pertaining to India. Again, talking about inflation. Earlier, it was seeming that, December is when we are looking at rate cut. RBI was getting ready, the stance was changed, but now it seems with the sticky inflation figures, two readings have come pretty high. Do you really think, and RBI has clearly stated that it's more focused on containing inflation, it doesn't have a dual, intent, but it's clearly focused on containing inflation. Do you think we'll really read the state when it starts hurting growth, which is already a little bit on the weak foot? So you're thinking about that, Abhilash?
Uh, Thanks, Nidhi. Yeah, I think obviously the last two inflation prints did come as a unwelcome surprise to the markets, and I guess RBI as well. Now, if we look deeper into the drivers of inflation, right? There's one very clear driver, and that's food prices. So if I remember correctly, food prices have increased about vegetable prices have increased about 36% year on year. And if you look at vegetables like tomatoes, onions, etc., their inflation is more than 60% year on year. And there's very little the RBI can do to actually help with that supply demand mismatch. If you look at actually the core inflation, which is inflation stripping out energy prices and food inflation, which are the more volatile components, core inflation is around 3.6, 3.7%, which is below RBI's target of 4%. So it's a challenging situation from an RBI's perspective, because the headline inflation, the inflation that people actually feel is high, but keeping the rates high isn't going to solve the vegetable price inflation. Now, I think there are two takeaways or 2 points to consider. One is that, yes, as you pointed out, RBI's mandate is to curb inflation. It's not a dual mandate. And that's why we think that, in the December meeting, they're probably going to stay on hold. They're not going to cut rates. Earlier, we were expecting a December rate cut, but given the inflation surprise, we've pushed that back. But then, next year, probably from February onwards, it's of limited benefit from a policy perspective to keep rates elevated, right? Because it's not going to bring down food prices. And then if you think about it from a seasonal perspective, we are going to see, cooler weather happen. We'll see a new sort of season of harvest. So maybe we'll see a more sort of curtailment in the food price inflation. So in December, in January, you could see food inflation ebbing, and that could give RBI, a window of opportunity to cut rates. Now, as far as cutting rates to support growth is concerned, never say never. Obviously, RBI is cognizant that the growth picture does matter. It's not the stated objective, but we don't think we are at a point yet where RBI needs to come in and deliver emergency rate cuts to support growth. Because yes, while growth is slowing down, it's slowing down from a very elevated base, and we still expect the growth to land in at around 6.7, 6.6% next year, which is still a healthy level. So inflation will still be the key, but we should expect food inflation to come down and allow RBI to cut rates in February.
Thank you. Thank you so much. We very much close to the end of the call. I won't take any further questions because there are some more. So thank you everyone for joining, and we definitely take the key takeaways. I mean, US economy doing strong, but we still waiting how various actions, which the Trump administration has talked about pans out, actually not really jump to conclusion. It can go either side. I really like the topic about where you mentioned about silent earners, how India is actually taking gradual steps and owning, its rightful place in the global economy. And definitely, hopefully, the way inflation cools out and things move from RBI side as well. So thank you everyone for joining. Thank you, James, and thank you, Abhilash, very much so for sharing, both perspective. There are two sides to the coin, and you brought it about very beautifully. So thank you everyone when we close the call today, and a happy weekend to everyone.